Hi, welcome to the slideshow. This is based on the work of Harry S. Dent, and we like Harry for several reasons because he has a really good track record, frankly, of calling many contrary but accurate predictions about the economy. In 1994, he predicted that the federal government would wind down deficits and have a balanced budget by 1998 to 2000 because he saw the boom of the baby boom generation coming, the financial boom, and knew that that would raise revenues for the government to a degree so much that we would actually have surpluses. And the outcome was that the federal budget was balanced by 1997. But he's had other good calls on inflation coming down, where oil prices were going to be, mortgage rates and other things, usually during a time when it wasn't clear and he would be ahead of it. Now, predicting the market short term, much more difficult than predicting the economy. The market doesn't always obey the economy because we have so much government meddling and influence, and there's now today such a disconnect between the economy and the stock market that sooner or later the stock market will have to match up with what the economy is doing, but it could be very painful to the degree that if it's not currently doing that, then by the time it readjusts, there could be some pain to deal with on that. But you study the economy first, and the stock market, it's just going to do whatever it does until it catches up with the economy through the sheer forces of nature. And in understanding economies, Harry bases so much of his work on demographics. During the dark days of the George Bush I recession, when George Bush was saying, "Read my lips," and Clinton was winning the election based on, "It's the economy, stupid," Harry writes a book called The Great Boom Ahead. And what he really did is he determined that just due to the birth rate and the demographic football going through a garden hose that the baby boom generation was, that it was going to power a boom through the 90s, that it had in fact powered the 80s boom. And there was a sort of a settling factor. The economy does breathe, by the way. Things boom and everybody leverages into it. And then not all that leveraging into it is good, and things slow and people get hurt and it contracts. And if it can shed that extra baggage, it starts to grow again. You're going to learn a lot about that if you follow us and follow the studies that we do on demographics from Harry's work. So he wrote The Great Boom Ahead in 1993, followed by, more recently, The Great Crash Ahead. And this is all about the expansion of the economy through the baby boom generation, which is a formidable force. You've got to realize baby boomers are 83 million of the 300 million people in this country. And generally, at this point in time, what they are doing economically, it's a dominant factor in demand in this country. You'll hear other theorists tell you that it is loose money that creates demand, but Harry insists, no, it's people that create demand. And if you gave aging baby boomers in their late 50s and early 60s now all the credit in the world to buy everything in the world to try to stimulate consumption, they wouldn't do it because their stage of life demands that they don't consume. The kids are out of the house, and it demands that they pay off debt, not take on debt, and that they save their money for retirement. So what he's basically saying is demographics are such an important influence that governments can't over manipulate the economy against demographics. And the fact that they're trying to is part of the worldwide problem today. So what we're going to really cover here is what's happening in Spain and the influence it's going to have on the rest of the world economy as Europe starts to finally crack. Okay, so the important story we want to tell today is one of Spain, because Spain is on the edge here of complete failure, like Greece, along the lines of Greece, but it's 5 times bigger. And Spain is, as they really are beginning to say now, it is too big to fail. If it fails, I mean, look, what's happening in Greece right now is as they're contemplating, Greece won't make it, and they're going to have to leave the the euro. It's causing a run on the banks. People in Greece go, let's see, I could have euros or I could have a devalued drachma, and the banks are being asked to give all their money back. It's a huge problem. When that dries up to where the banks can't give out any more money and they freeze, boom, you have you have some social calamity along with the repercussions around the globe. But that given, what I'm about to show you are the stats of Spain. Spain is 5 times bigger. And you can bet that if Spain goes down, it's going to affect the rest of the European Union. And what people in America don't get is that when that gets severe enough, it will come home to roost, and we're going to have our own problems as a result of it. But let's move on and take a look at Spain in particular. And by the way, these slides are courtesy of HS Dent. Go see hsdent.com, become a member, attend the conferences with them, get Harry's monthly newsletter. Just a wealth of information that we rely on heavily for our radio show. So thanks to Harry for this, and we may hear from Harry in a couple points along the way on this slideshow. Okay, before I get into the basics of Spain, I need to give you a quick lesson on demographics so you understand the charts you're going to be looking at. What you're seeing here is changes in spending at each age and stage of life. And essentially, in a modern and industrialized economy, as we age, we go through very predictable spending stages of life that occur at predictable ages. So this chart just kind of lays it out graphically. As we age, we usually earn more income. We spend more up until our average peak spending age of usually about 47 years old. And between 18 to 47, we go through several stages of life. So we just enter the workforce at 18 to 22 years of age, to getting married 22 to 30 years of age, and then starting a family, to purchasing our first home at ages usually from 31 to 42. That's the stage that we incur the most debt, and our spending continues to increase, particularly if we're having children and they eat potato chips and cookies and want trips and jet skis and Dodge Caravans and all of that. We will continue to increase our spending to about age 47 as our kids reach their late teenage years and are still living in the household. And typically around 50, the kids leave home. And that is where we begin to spend less. We focus on paying down debt and we start saving for retirement. We don't necessarily make less, we just spend less. So that just represents a typical consumer lifespan. And again, what we're going to talk about later on is the fact that, no matter how cheap the government wants to make money, it's almost an unalterable pattern that happens in a generation. Okay, here you see the consumer life cycle. And basically, again, along this idea of consumption, personal consumption, or what people do as consumers, actually represents about 70% of the gross domestic product of the United States. Now, why is this important? Well, it means that how people as consumers spend money is the largest influence on our economic health. As larger groups of consumers age and spend more, the economy grows. When groups in the population pass their peak stage in spending, this leads to less spenders and it slows down the economy. So, what you can see here is that you've got, what do people buy in these different ages of life? You've got apartments and shopping centers are big if they're servicing people that are 25 to 33 years old. Starter homes are big for people in their 30s. Trade-up homes, vacation homes are good for people in their 50s. This kind of tells you where you might invest in an economy if you follow the bulk spending pattern. You look at how many people are in that segment of the economy, kind of tells you who to target your marketing to and how big your potential market is to actually approach. All right, so new generations come along about every 40 years, and as they age, they move through predictable earning, spending, and productivity cycles. Now, the peaks and troughs of these productivity cycles can be forecasted by just moving the birth index forward by the appropriate number of years. So the Dent method that Harry Dent works with reveals that economic boom and bust times can be determined by these demographic factors. Individual spending tends to peak in the mid-40s. So you have peak spending in mid-40s. So thus, aggregate spending of the country should correlate with the size of the mid-40s population, which is why we had a boom in the 90s into the early 2000s, etc. Now, if we plot the estimated size of the mid-40s age cohort with the projected year, we obtain a generally rising trend that shows a number of peaks and troughs due to past variations in the birth and immigration rates. So, for example, fewer babies were born during the Great Depression than ever before or afterward. Thus, we would expect that 45 years later, during the 1970s and early 1980s, there would be a corresponding drop in the number of middle-aged people. So economic boom times are associated with an increasing size of the mid-40s population, and bust times are associated with a decreasing size of this population. The oscillation in the number of middle-agers at their peak spending years is called the spending wave, which I'm going to show you on the next page. All right, so here's a picture of what's called the spending wave. Now, the spending wave predicts the health of our economy by moving forward the birth index, in this case, 47.5 years. Now, why this number? That is the average age at which consumers reach their predictable peak in spending. So, by our mid-40s, the average American families purchased the largest home we'll own, all the furnishings to go with it. We spend money on clothing, food, and education for our teenage children. And once the children leave the nest, the fixed costs remain the same, but the variable costs suddenly start dropping. And though this frees capital for discretionary spending, it actually marks the end of the necessary family spending that actually is the engine that drives the economy. Now, the essence of the spending wave is simple. Predictable spending patterns drive the economy, not changes in interest rates and all these other things. And this is our complaint, is that the government tries to manipulate our way out of these peaks and troughs and perverts the process and creates bloating, creates excess debt, excess liability, and then when these things shake out, they shake out even harder. The spending wave chart here illustrates that the close correlation between the birth index moved 47.5 years actually correlates to the Dow Jones adjusted for inflation. Now, I would submit that this is getting more and more perverted, and more we're seeing graphs that don't correlate to this because of the government perversion against economic and organic factors that they're trying to manipulate. But at the end of the day, the stock market has to readjust to what these demographic factors would have made it do. So, but in this case, as you can see, historically, the spending wave allows us to see what the stock market will, when it'll grow and decline, almost 5 decades in advance. Equities, especially large company stocks, are the place to be when there's increasing numbers of a generation that are moving to their peak spending years. Now, what we're going to look at in a minute is the spending wave and the patterns that happen in, when you want to do a global thing. You can take this and break it down by country. Let's take a look at Spain. Okay, so here's the spending wave on Spain. What's odd about it is just how sharp it goes up and how sharp it declines. This would actually reflect births from about 1955 to 1975, and then somewhere after 1975, it just completely falls off. Now, while what you see here is that there's still some spending left to the Spanish generation, they've gotten themselves in so much trouble that it's actually offset their spending wave. And don't forget, what you're going to see in a minute is where the peak housing buyers are, which have now, that age of people that were 30 to 39 within this wave have come and gone. So the housing buyers are already starting to fall off, that you're going to see in the next slide. But I want you to just hear real quickly what Harry had to say about this particular slide here at the conference.
Spain is worse than Greece. Spain had the biggest real estate bubble in Europe, along with Ireland, but had even more subprime lending. Half the banks in Spain are called casas, which translates into bullshit, okay, in Spanish. Unregulated banks. Most European countries and Canada and Australia never had the level of subprime lending. They have way overvalued real estate, and that still gives them huge liabilities and bad debts. But they never had this no money down, no doc loan sort of stuff. Well, Spain had more of that. Here's Spain's spending wave. Spain actually is in the deepest trouble right now of any European nation, and they've actually got the best spending wave. That's how bad off they are. Their spending wave peaks later. Most European countries plateau somewhere between 2010 or 15, then drop like a rock. Spain goes up till 2020 and then drops like a rock.
Okay, so if you take that demographic and then you go to the actual people that are 30 to 39, which are the primary biggest part of the population that buys homes or buys new homes, you can now see that that has moved on. That peaked in 2010. Now, you got to understand, Spain's problem is its housing bubble, just like it was in the United States. But their fall off of the population, they are losing in the next 10 years about 40% of their major buyers of homes. Their housing demand wave diminishes by 40% over the next 10 years. And I want you to hear what Harry has to say about the correlation between housing bubbles and economic collapses.
The thing I looked for, the countries that are always going to be in the biggest trouble when you get a meltdown, are the ones that had the greatest real estate bubbles and booms. That's where the banking sector is the most vulnerable. That's where you get the most debt deleveraging and the highest fallout.
So let's take a look at Spain's fallout. So here you see their unemployment rate just outrageous. It's, what is that, 23%. Now keep in mind, they also are one of these southern European countries that have offered tremendous benefits to their older population. And all of these calculations around the world have been calculated with some sort of tax basis that was not supposed to be diminishing. So as the population ages, you've got a fallout from a real estate bubble that's producing this kind of unemployment and reducing revenues. And then the country wants to borrow from other countries to get out of it. That's why you see their interest rates sky high, because people that are being asked to lend money to the government of Spain don't believe they're ever going to see that money get returned. And then again, once interest rates go sky high and they go into the Spanish economy and the Spanish people can't borrow except for outrageous rates, it slows the economy down further. Now, be warned, this is the exact cycle we're worried could occur in the United States. So what's unnatural is that we are so in debt and the world is willing to keep buying our debt for 1% rates. At some point, the end of quantitative easing, the end of cheap money occurs when the world decides that your debt is not the greatest bet. And just one more further look here, which would be unemployment of those able to work under age 25 in Spain is 50%. So just another look at the potential for some trouble there. Again, Harry's comment on this.
I don't see how they don't already have massive riots in the street. They're starting to. But if the economy keeps getting worse, this is a disaster waiting to happen. How can a country have any future when its young people are mostly unemployed and their demographics are failing for decades and decades to come?
So on this graph, you get a good comparative of the Spanish real estate bubble versus the American real estate bubble. We have on this graph doubling of home prices in the United States over about a 5-year period, not for any change in income levels, but simply because banks were able to just start giving away cheap money and bubble it up. Spain, about 40 to 50% higher than our bubble. And our bubbles already began to deleverage back down. The Spanish bubble has not yet really begun to get its momentum back down. And in so many cases that I've studied, from work of John Talbot in Coming Crash of the Housing Market, which he wrote in 2003, and the Case Shiller Index, which you can find, which is an index of housing prices adjusted for inflation. And you look at these graphs, and almost every single bubble in housing eventually falls back down to its beginning. So the longer the Spanish bubble doesn't deleverage, then the more ahead of them they still have serious deleveraging to get through. Okay, here's another look at their housing bubble, which is house price to income ratios around the world. And here you see, these small, Australia It's going to be dealing with some stuff here up the road. But the Netherlands, Belgium, they're small to bail out if they run into trouble. Spain, much bigger. And look at Spain here, which is the fourth from the left, versus the United States, which is the fourth from the right. And the adjustments here of what it costs to buy a home relative to income in 2000 versus 2010, just another clear visual signal here of how deep the Spanish real estate bubble is and will continue to deleverage from. Now, this was a statistic I was completely stupefied in seeing, and that is, we all know people in the United States that lost their jobs in construction. Well, but the highest we ever got in terms of the percentage of the workforce that was involved in construction was about 5.8%, and that has fallen to about 4%, and yet we sure all know a lot of unemployed construction workers. In Spain, at the peak of their real estate bubble around 2008, 13% of their workforce was involved in construction. So as this demand and this over-leveraging continues to shake out, that's got to affect more and more of what you saw earlier in the unemployment rate. And mind you, the government wants to print money, wants to get loans, wants to borrow money to try to stimulate the economy back. But when you've got 13% of your workforce working in an industry that's not going to come back alive, where are you going to get the tax revenues to pay those loans? This is the vice that Spain, as a microcosm of the larger macrocosm of Europe, is in, edge of the precipice in terms of cracking between stimulating their way out of recession and completely folding in any ability to pay off their loans whatsoever. Banks with the largest exposure to commercial real estate. Need I say more? I'm going to let Harry describe this one.
Bad loan ratio, and it's just starting, is already near what it was at the worst of the crisis in the early to mid-90s. And Europe had a bigger housing crash than we did in that cycle. So this is just getting going. I mean, you know this is going to go to 15, 20%. Spain has no way out of this. People who are thinking that Spain's going to somehow be able to cut some expenses, get their economy back going, are in absolute, total la-la land. Spain is going to default. It may be 2 months from now. It may be a year from now. It's probably not longer than that.
Amazing statistic here. Household asset split in select nations. United States, we've lost a little bit of our real estate bubble. We've had some severe downturns, but currently we're at about 26% of the household assets are in real estate. You got 7% in non-financial assets, and we've had a surge in the stock market since the real estate bubble fell out because of quantitative easing and the dollars that the Fed is being pushed into to prop back up the stock market. Not that it's really helped the economy much, but it's certainly propped back up the stock market, which is the pink. Okay, but in Spain, still they've got, and Harry says they're looking at 60 to 70% fall off to get back to the bottom of the bubble in real estate, and yet their population has 79% of their household assets are in the real estate market. Now, in the United States, we always talk about how much money we owe to China. Well, the amount of debt in the United States that's owed to people outside the country is about 20%, as you can see on this graph. In Spain, it's 90% of their debt is owed to people outside of their country, and Greece is 110. Now, one thing Harry points out is countries that are most likely to default are the countries that owe money outside of their own people. It makes them a little more carefree about defaulting on their debt because they owe it to foreigners. That might sound a little simplistic coming from me, but the point is that Harry says historically that is what occurs. Now, this shows a pattern that we're currently, at the time that we're recording this, hearing about Greece, which is there are runs on the bank in Greece. Now, what happens first is that the wealthy people just sort of start to move their stuff over to Switzerland and get them into other banks, and the average person is kept in the dark. And at some point, when the light goes on, for example, in Greece, that they have a choice of either getting euros out of their bank account now, and then if Greece defaults, it goes back to the drachma, it's going to be a drastically devalued drachma compared to a euro. Well, now they're holding euros, and it causes runs on the banks. You are starting to see bank accounts rolling out and over in Spain, meaning that people are pulling money out of the banks. And it is starting that trend. If this starts to get more severe, you're going to see this accelerate. This probably represents only the wealthy people starting to move their money out. When it gets to the middle class, that's where these start to get severe and become runs on banks. And when banks have runs on them, history is made. And I don't mean that in a good way. Okay, so this is sort of where the rubber meets the road on everything, which is let's take these countries like Portugal, Italy, Spain, Greece. Let's start to add them up, and let's assume that they're all in somewhat of a similar state, which is pretty severe. Once you get into these big countries, it becomes impossible to bail them out, because right here you see already with Greece what has been happening with the balance sheet of the European Central Bank. That's the top one. Look at how it has been going up and up. They are just creating loans and loans and loans to countries, and they haven't even begun to bail out Spain, Portugal, and Italy. So this is where somewhere everything hits the wall. This is what's at stake here, is how much more can this be stretched? How much more can the European Central Bank simply create money out of thin air and give it to the rest of Europe? And then now you've got even where they've been told austerity basically means we will give you money if you collect high tax revenues on income and you stop giving benefits away. And what do these guys do? They turn around and they say, we're going to elect a leftist government of some kind. I'm not being left or right about this, but they're electing governments that say, no austerity. We're not going to bite the bullet. You give us the money and maybe we'll pay you back. Maybe we won't. They ain't going to get the money in that way. So this is where the whole thing really comes teetering, and you have some major social stresses, societal stresses between the countries and the players in Europe. And I'm going to let Harry talk to you from our show on where all of this begins to turn into a global situation that is going to affect your stock account, your index, your IRA, your 401k, how this comes to the shores of America. So I'm going to go back to an interview I did with Harry. You can hear the full version on our extended podcast on this website. But on this, I asked him, how does this come to America and how does this impact us in the long run? Now, we're going to cover that, and then right after that, I'm just going to cover a couple slides with you on what you can do about it and how do you protect yourself, how to preserve your assets, and how do you prosper in the coming decade. I'm going to talk about that and wrap up this slideshow. Let's go back and focus on the baby boom generation here in America that is approaching retirement. And they've got 5 to 10 years, or they're beginning now. How bad will the repercussions of Europe ultimately be for American investors that are at this stage of life? What are the dangers here?
It's that Europe triggers the next global downturn. We have a massive demographic slowing over the next decade. We have the greatest debt bubble in history. In fact, we're more in debt than many countries in Europe, less than the UK and Ireland, but more than most other European countries when you add up all the public and private debt. So we had our own debt crisis. Everybody saw how bad the economy got in 2008. If the government had not stepped in with the most massive stimulus program in history and hadn't guaranteed every damn loan and bailed out every company, we would be in a Great Depression already. So we've got a depression brewing without Europe. So Spain blows up, Europe blows up, their slowing hits our exports, hits our banks and all our credit default swaps and all these ways we're intertwined. It spooks our market. The only reason our market's corrected over the last couple of years, it's almost always been around Europe, because if our economy starts to slow, then the market's assumption is, well, we're going to get more crack. We'll get more stimulus, and that'll cure that short term. But when Europe starts to blow up or something, we don't have any control over that. That will affect our economy, will affect our banks and investors, and then that triggers our economy slowing down, and then guess what? Between the slowing of Europe and the U.S., that hits China's massive export machine, and China's the most overstimulated, bubbled economy in all of history, worse than us, worse than Europe. China's bubble and real estate bubbles burst, and then countries, all the emerging countries in South America, Middle East, Africa, and everywhere in Asia, feeding China 50% of the industrial metals in the world, for example. Their exports collapse, and we have a worldwide crisis. Europe, North America, China and East Asia, and then the emerging world. We see a worldwide collapse.
Welcome to Straight Talk Wealth, heard every Sunday night at 5 p.m. with your experts in all aspects of wealth accumulation, preservation, and income planning guaranteed to last a lifetime. And now, your host of Straight Talk Wealth, Bruce Whitey, on AM 870 KRLA.